The rupee, as we told you, has strengthened for the 5th consecutive session against the dollar, in fact helped by continued interest from foreign institutional investors in the equity market. The Indian currency has now recouped most of its losses it saw earlier this year, currently trading at 66.22 to the US dollar. All right, significant portion of the slight slip in our markets came in the last hour of trade, with benchmarks reacting to news on China. In fact, rating agency Standard & Poor's cutting their outlook on China from stable to negative and projecting the country's growth at or above 6% per year over the next 3 years. What does this really mean for China and emerging markets? Like India, we are joined by Naeem Aslam, who's the chief market analyst at our trade. Let me come to you and understand the implications of this as we spoke, as far as India goes.
Yes, hi. Thanks ever so much for having me. If the news by this rating agency is coming up or coming across as a comic, then your postcode must be based somewhere in Disneyland, because given the fickle nature of the Chinese debt market, credit worthiness has been it's been on a continuous path of a very weak and very unstable outlook. So this reaction that we have seen by the S&P, it was not something which wasn't unexpected. It was completely in line, because the rest of Chinese credit has been gradually inflating, and while People Bank of China is combating feeble growth and trying to keep it above the 6% GDP, it is very difficult for the People Bank of China not to have more credit in the market, but at the same time, those credit worthiness is not something what the market is looking for. So profit growth in Chinese banking sector is just another element of a major concern among traders. One of the 8 largest banks in China, they have, for the first time in nearly 20 years, they have almost defaulted on their debt, and they don't have enough funds to pay for the bond payment, which is approaching on the April 24th. So this, all in all, I think that what S&P is trying to do is that they're trying to increase the pressure on the Chinese government and on the People's Bank of China. That look, you have to combat and you have to increase the pressure with respect to reforms. Yes, we do appreciate that you are taking necessary steps and measures to battle these reforms and then try to erode all this corruption in the system, but still we need a lot more from with respect to reform.
Fair enough, Naeem. But when you talk about India, do we see it as an opportunity here? Because if the ratings are cut there, how do you see India's growth story get impacted on the back of the concerns that S&P has raised as far as China goes?
Yes, in comparison to China, India is a very small market, so that doesn't mean that there would be a much more emphasis, or those traders will start reverting back to India. Because if you look at the Hang Seng Index today, it has entered back into the bull market. Now, this is despite that the S&P has cut their outlook on China into a negative territory. But yes, India itself has been one of the strongest performing countries within the emerging markets. So the growth opportunities are certainly there. But if you are comprehending or anticipating that perhaps this move would have more investments coming towards India just because their credit worthiness has negative outlook, then certainly that would be too much far stretch to say that, because the Chinese market still has a long way to go. It is, yes, the credit worthiness is something still there. And with respect to corruption, both countries are equally, let's say, under the influence of this.